Inflation expectations just broke out to 5.2%, the highest level since March 2023. Here is how this hits your portfolio. If you trade the headlines, you bought precious metals. So why did silver just crash 21%? Why did it slice straight through multiple layers of technical support? And let me be clear, we were warning this will happen in our previous videos. Retail traders are bleeding in silver and precious metals right now because they trade first level thinking. They assume inflation means higher metal prices, but institutional capital trades second level mechanics. They trade real yields, structural deficits, and exchange margin requirements. But you should know that there is a massive rotation happening under the surface. While many are watching their silver stacks lose value, the smart money is watching a fertilizer margin squeeze that is about to tear through the global food supply. Look at the 10-year minus the 2-year yield spread. From a technical standpoint, every time this spread uninverts and steepens, it signals a violent regime shift. Here is the fundamental catch. Inflation is proving sticky. In response, bond markets capitulated globally. The market stripped out 3 rate cuts and is now pricing in a hike. The 2-year Treasury yield printed a massive 53 basis points bullish engulfing candle in a single month. That momentum spike drives up real yields. When institutions can walk in a risk-free high yield from the US government, holding a zero yield asset like silver becomes a fundamental liability, so they dump it. But silver takes a double hit. It is not just a monetary metal. It is highly industrial, and when rates stay higher for longer, manufacturing contracts. Fundamental demand destruction fears cause silver to crash even harder than gold. That is why it dropped 21% and broke its long-term moving averages. When real yields reverse, metals get crushed short-term, but money does not disappear. It rotates into the root cause of the inflation, crude oil and commodities with hard supply deficits. This is the out-of-the-box trade. Look at this chart from Katusa Research. It measures how many bushels of corn it takes to buy 1 ton of urea fertilizer. It just hit 133 bushels, the highest ratio since 2022 crisis. This is the ultimate margin squeeze for farmers. Why? Because geopolitics sent crude oil up 48% to $98 a barrel. Fertilizer is a petroleum based. Now look at history. In 1973 oil embargo, real yield surged, gold corrected 25%, but wheat rose 133% in the following months. In 2008, oil hit $147, gold pulled back around 30%, and agricultural commodities kept climbing. In 2022, Russia invades Ukraine. Oil surged 60%, gold corrected 22% between March and September, and wheat rose 50%. Fertilizer costs jumped 80%. Now let's look at corn futures. It is consolidating and testing a massive overhead resistance at 470 cents. When fertilizer input costs evaporate margins, farmers refuse to plant corn. They pivot to soybeans, which require less nitrogen. So if corn breaks that 470 resistance on supply destruction revisions, we get a short squeeze. This is longer play, but plant season is approaching. Wheat is already showing momentum, surging from its base in the 500s and testing psychological resistance at the 600s. Sugar is at 5-month highs of 15.70 cents, bouncing off from a multi-year technical support at 14 cents. It is not just candy. Brazil mills sugarcane into ethanol. At $98 oil, fundamental arbitrage means they pump ethanol instead of exporting sugar. The global sugar supply literally evaporates into gas tanks. All of this is happening while the United States debt goes parabolic, crossing $39 trillion and adding $1 trillion every 100 days. The dollar index is breaking out above 100 A technically strong door is a wrecking ball, as we were explaining in our last video, making fertilizer exponentially more expensive for the developing world. We track raw data and technical structures, not Wall Street narratives. To see the shift before the crowd does, please subscribe. So the obvious question is, are precious metals dead? No, and let me be perfectly clear on the fundamentals. Long term, precious metals are going significantly higher. The global debt problem is now on such a massive, unprecedented scale that continued fiat debasement is a mathematical certainty. They cannot sustain those high interest rates forever with 39 trillion in federal debt. Eventually, the structure breaks, rates are forced lower, real yields collapse, and silver will stage a massive breakout higher. That is the long-term bull case, which is exactly why the only strategy that matters is holding those metals for the long term, preferably in a physical form. Trading metals on a short time frames right now is extremely hard because of the exact brutal technical volatility we are seeing today. But here is the fatal macro flow for the retail investor trying to time the bottom. They are ignoring supply reduction. The US is depleting the strategic petroleum reserve. They just authorized 172 million barrel emergency release, and it still failed to dent the $98 crude bullet. OPEC is unwinding voluntary cuts and supply remains tight. So if the Fed is forced to hold rates higher for longer to fight this oil-driven cost-push inflation, silver remains trapped below resistance, punished by high real yields. However, if oil loses its fundamental support and crashes below $75, this entire agricultural cost-push thesis is invalidated. Inflation fears subside and yields retract. Do not trade on emotion, watch the technical battle lines. First, watch the US 10-year real yield. If it pushes above 1.5%, the silver crash will accelerate down to a structural support around $55 a ounce. If that real yield rejects and breaks back below 0.5%, the bottom is confirmed for the precious metals. Second, watch the crude oil. If oil holds fundamental support above $85 through the end of April, the fertilizer squeeze is mathematically locked in. Corn, wheat, and sugar will break upper resistance later this year as the yield deficits are realized. The USDA releases its prospective planting reports on March 31st. That print is the fundamental catalyst. It will reveal exactly how much acreage farmers abandoned due to margin compression. That is the level that matters next. See you in the next one.